All right. Good morning, everybody. Short week, so keep that in mind as we go through. Everybody's all hyped up on the bill. If that stalls out, the markets might have a little bit of a hissy fit or, you know, throw a fit. Keep your eye on the bond market. That one's going to most likely be the impact. If the markets don't like the bill that's passed, or if they don't get a bill passed, then bonds are most likely going to be the vehicle where they express their feelings. Got a bit of a mixed bag around the world. US is in the green and nearly equal. Usually that's a sign of algorithmic playthings. They're running it in sync and they've got an agenda to just hold the line. Everything else, a bit sloppy. Japan down. Keep your eye on that one. Still looking to see if we're going to get anywhere there. And it will directly affect bonds and yields anyway. So it just takes us right back to the same thing. Keep your eye on treasuries. All right, we're going to be getting more jobs data this week, but we're not expected to break the big one. So, in the later part of the week, maybe say around Wednesday, we start to get into that hurry up and wait mode through Wednesday afternoon into Thursday. And of course, we're not going to be here Friday. So if there's going to be any impact, it's likely going to be Thursday when we get all of this data that ends the week, since they're going to have to take everything that they couldn't report on Friday and put it into Thursday's day. And you can see that we've got some trade deficit and ISM on Thursday, along with the unemployment numbers. I don't see anything here of Japan having any announcements tonight into tomorrow, but FX Street doesn't always do a good job of catching all the Japanese speakers. So, all right, but there we go. BOJ governor tomorrow morning around 9:30. But I would look for something in the overnight hours, see if he has something to say in there. That's what I was looking for. I just didn't think it would be so late in the day. There was some talk about Europe and getting a deal done. The tariffs are supposed to hit a brick wall by the end of the week, so that's something else we want to keep our eye on in the. And it could tie in with this European Central Bank Forum on central banking. I doubt just be mindful what's going on. It's a challenging and a risky week, all things considered. So base case would be to reduce your position size, right? And or lock in gains on positions and reevaluate if they're still worth holding. And as we covered Friday, there is still no signal to short this market. Sure, there's a bunch of bobbing heads on TV, but all of the market breadth tools, all the macro things that I have, nothing says that we have a short. We just have a lot of reasons to believe that we shouldn't go up anymore, but we just keep going up anyways. Took a look at the spot gamma levels this morning. I believe the call wall stayed the same and the put wall backed off a little bit. I should have just took a picture of it because I seen something shiny since then and forgot what it was. So let me catch a picture of it and you guys can see it. I put the spot gamma levels in the channel every day. So you could just look at where we were and then look at where we are now. Yeah, the call wall stayed the same and the put wall rolled up. That's what it was. So SPX put wall is now at 6130 hog line. Like I said, I'll put a picture in the chat so you guys can see it and be able to compare it with what I posted last week. All right, I got that done. So the put wall being rolled up is a bullish bias. But with the call wall not getting rolled, then it's just pinching price. 64,000 in the overnight. It's a little above the norm that we saw last week, but we're still, in a decent range. Volume wise, we're not out of line. Price is above all the major moving averages. There's nothing on a daily chart with a moving average over our head, so that's good. Of course, if we're above all the dailies, I think we're above all the weeklies. Shouldn't be anything out there. Yeah, we're above everything. So there's nothing over our head to hit. If we were to consider an indicator that would put something over our head, it would be something like the acceleration bands, Bollinger bands, maybe a Keltner channel. So it wouldn't hurt, to put one of those on and see how far away we are from hitting one of those levels, especially on the weekly. A daily Bollinger or a daily Keltner, doesn't really do it for me. But if we were to hit one of those levels on the weekly, it's much more likely to see price respond. And, you could do it in the ES, but you'd be better served to do it on the SPY or QQQ, preferably after the open. Otherwise, we're still above the zero gamma and the volatility trigger. So we're not expecting any new behavior out of the dealers. We would expect it to continue to be sell into strength and buy into weakness. We can see that they did that on the breakout Friday, and they did that on the breakdown Friday. So they sold into that strength and they bought into that weakness. It's the entire premise of how dealers will function when we're in a positive gamma environment, right? That's exactly what we expect. We still closed better than we closed the previous day. So it was a green day, right? It was positive. And that's just market logic 101. We continued to move to the upside, still putting in lows, still putting in highs, just higher highs and higher lows. We are at today's ADR half. I mean, we haven't hit it yet, but we're really close. And depending on where your machine starts, we may have already hit it, right? I think this one is starting where we opened in Globex, but if I was on TradingView, I think it would have started at where we closed last night or vice versa, right? I know that they're not run the same. And if we had run that from the 4 o'clock close rather than where we opened at 6, it's very likely that we would have already hit it. So, don't get too hung up on just a few points one way or the other. If we get to one edge early enough, we can go to the other edge by the end of the day. It's a common enough phrase. This is the edge that we're talking about. So we could go to the other side by the end of the day. This has nothing to do with being bullish or bearish. So me saying we could get to 61.90, just for some round number talk, that wouldn't make us bearish. At least it wouldn't make me bearish. It would be a lot like Friday, where, we went down to a lower level and then came right back up again. And we still managed to close higher than the previous day's close. So for today, all we got to do is close higher than 62.20, and they're going to say it was another bullish day in the market, right? Those bobbing heads on TV who don't know what the heck they're doing. We continue to see a reduction in the volatility in the market. We're down to around 72 points a day on the average daily range. Still above 1%, but this thing was exceeding 115 points a day for a while. So, being down to 72, it's a lot less volatile. Remember, the market has a phrase when it comes to volatility, and it's not exactly true, but it's the one that they use. They say when volatility is low, it has nowhere to go but up. And that, obviously, that's not true, right? We can just stay low for long periods of time, and or heck, we could go lower. Same thing is true the other way around. If we're really high, they say, well, volatility is high, it has nowhere to go but down. Yeah, no, that's not true either. It could stay where it is at that elevated level, and of course, volatility could always go higher. But generally speaking, sooner or later, that phrase is right. At some point, low volatility does transition to higher volatility and vice versa. So if we're in a low vol environment now, sooner or later, we're going to go back the other direction, be in a high vol environment. If they don't do something with these tariffs, it's likely we're going to see some high volatility by the end of the week. Today's floor pivot is higher than yesterday's. That's bullish. Price opened above it, and that's also bullish. We are already significantly expanded above the weekly floor pivot. That puts us in a bit of a bind already, because the distance from the floor pivot matters. It's not as good as the distance from the 10-day or the 10-week, but you always want to be mindful of how far away we are from the weekly pivot point. Now, I've tried to map this out like I've done with the 10, and it doesn't work as well because the 10 is a continuously moving piece. It's always there. This resets with new formulas every week. So the only way that I could really do it was to normalize the weekly pivot, do like a moving average of the pivot, which is what John Person did with Person's pivots, and then check the distance from there. And I didn't like the outcome that I got. So your best bet is just to measure the distance from the upside. I've seen the ES get 3.5 to 4% away in high volatility conditions, typically in a bear market when dealers were buying into breakouts. So they were buying into strength, and we could really expand away from the weekly pivot in a short period of time. We're not in that environment, right? We're in the other way around. Now they will sell into strength. So I don't know how far we can get from this weekly pivot before we stall out. But I would say start with what we have. not quite 2%. And from here, every quarter, so when we get to 2%, check it. Maybe halves. Start with 2%, 2.5%, 3%. I don't think we can get beyond 3.5%, especially on a short week, but that's what I would be mindful of. And it will look a lot like a topping pattern from Friday, right? We'll end up maybe something more like Wednesday. We'll end up getting into a zone and we'll just chop there and be unable to get any further. Maybe do one last hurrah, and then we will head back towards the weekly pivot. And that's if we can even maintain this distance in the first place. For all we know, they're just going to sell into it by midday today or tomorrow if we don't get some tariff news that makes everybody all happy. Or the bond bill doesn't get passed, right? Either one of those two, because the clock is ticking for both. We are at R1. You see how R2 was the end of the run on Friday? We almost made it back to that pivot point, but we didn't. So this is an MDP that counts today. It's a missed daily pivot. So far today, we have not hit our pivot either. So we have an MDP so far today that we would count for tomorrow. Keep your eye on the R2. If we do continue the drive to the upside, that's very likely where we stall out. Otherwise, if we break R1 and start working our way back down, the floor pivot is the first target at 6211 cog line. It's very close to the midpoint of yesterday. If we can get through that, then we have S1 6192 cog line, which is really close to yesterday's low. Really don't have a reason to expect a breakdown beyond that, but from R1 we can go to S2, which is pretty close to 6150. On the week, it is a really wide weekly channel, which implies that if we break out, that the breakout doesn't stick. Well, we already are broke out, so that's just implying that for the week, we close inside of last week's range, that we failed to continue this drive to the upside. Last week's range was a really big range, so that doesn't really help us out that much, right? From 59.50 to 62.50, that's a lot of room. It's 300 points that we could wander around in there. So that big wide weekly pivot doesn't really give us too much info there. $61.50 for the week is the line in the sand. We need to hold that if we do get weak. Breaking below that puts us in a shallow zone, and we could get to 6,000 really quick. So we want to see that hold. It's 61.50, last week's point of control. It's the structural level of concern. And when we zoom out, we've got this other zone that we built over about a month of time. Overlapping floor pivots, in the 60-32 cog line area. Starts to get ugly under 6K. $62.32 is the value area of last week's point of control and floor pivot. So let's stay outside that box. Yeah, you can see there's nothing up here, right? We don't start to see anything until this 61.42 area. So as time passes and we lose these candles, it's very likely the point of control is going to move up to here. And we've got 1 week and 3 days before we get into these candles. So we're not likely to see the point of control move after it gets to 61.42 unless we stay in one spot and build out a lot of volume. like around that 6,200 area. We haven't paused and consolidated for a while, right? That was back here in this Tuesday, Wednesday zone. We didn't spend much time here. Before that, it was back here in this wider zone. We need to pick a spot, put in some work. The good thing is when we get the point of control moved, it still very likely should be underneath us. We hit that 92 cog line VPOC on Friday. It didn't help us out any. We cut right through it both directions. And I don't think we have a new VPOC. Yeah, because we opened and then we ran through it. So look, the textbooks will tell you to mark, the previous day's point of control and put it into today's trading. Of course, the books will also tell you mark the value area low and the value area high. And it doesn't really make any distinction on whether or not price has moved through those levels or not. I've got enough pivots. I don't need more. So for me, if it's already been hit, I'm not interested in it. Even with that being said, it got hit right at the open when we gapped up and moved through it. A lot of people will argue, hey, it happened in the Globex. It happened in the very first bar, the IB, let it go and still mark it. So you do you. The reason we're marking these lines in the first place is because it's where the greatest amount of trading took place. And if we were to revisit that level, it's very likely we're going to see a lot of trading activity again, either from traders' remorse or from some other reason, right? So we don't need to call it support or resistance or put any bias into it that says it's bullish or bearish. We can just state the fact that's where the greatest amount of trading took place in the previous session. And if we go back there again today, it's very likely we'll see a lot of trading again. So it's probably a level that you're going to want on the chart to be mindful of if we fade down into that zone, just because we're very likely to bounce there at least once. And if you're short, well, that can screw you up. So last week, we compared the projected week to the week we already had, but it wasn't set in stone yet, so it didn't count. This is Friday's range of last week. This is the range for this week. And as you can see, this week is a narrower range. Now that makes perfect sense because this range has two pieces of math in it. One piece is how many days we are going to measure. Last week was a 5-day week. The current week is a 4-day week. Obviously, if we're only going to use 4 days, price doesn't have as much time to move. Think about trying to do some math where you use miles per hour and then miles per half hour. If you can drive for 1 mile, you're going to get farther than if you can only drive for a half hour, right? The distance just gets cut off. Even if you were to go faster in the half hour, you just have less time. That range for this week, same problem. It just has less time. So it's a narrower week. The other part of the formula, though, is volatility. So generally speaking, most of our weeks are 5-day weeks. And when we compare one week to another week, they're both 5 days. The difference would then be volatility. So sure, the range is smaller because this week is a shorter week, but that may not be the only reason. And we can't exactly say that it's shorter just because it's a short week. Big events can cause the market to anticipate sideways, and we'll get a narrower week while we wait on whatever data it is that's making the market upset. Like FOMC week. A lot of times we'll get a narrower box on FOMC week because FOMC is volatility suppressing. We're still more than 4.25% above the 10-week, but we are starting to fade back a bit. Price doesn't have to fade to get back to the 10. All price has to do is move slower than the 10 is moving, and the 10 will get caught up to us. So it's a correction, but it's a correction in time rather than a correction in price. We did get a bit outstretched from the 10-week. We've been higher than that, but still, we were getting pretty extreme. So we're backing off from that. We need to sit tight and let the 10 get caught up to us, and or we need to get weak just even in a short period of time so that we can retest that 10, kind of reset the gauges. Looking at the distance to the 10-day, we're not even at 2%. There's no risk of mean reversion or heading back the other way. If we ask questions about did we move too far, too fast, does it owe us any sort of pullback? The answer is no. We're not at that extreme yet, which is a fun answer when you think about how far we have moved, right, in a single week. Almost 5% in these 7 days, right? From Monday to Monday, 7 days. 6 bars. Even with this 5% move on the 10-day, we're still not in extremes. So it doesn't owe us any sort of mean reversion simply from some idea that says we went too far, too fast, we're overextended, and it owes us some sort of pullback, because it doesn't. It is worth asking, though, after we've made a 5% move, what's more likely now? That we get another 2% higher? Or that we pause here? Or that we go back 1 or 2%? The odds say it's more likely that we pause here and or that we reverse here and we go back the other direction a little bit. The analogy that I use is still the same. If you haven't heard it before, just think of a runner trying to run up a steep hill. That's price above the 10. The further away from the 10 we are, the steeper that hill gets. And after, say, 1.5%, we start stacking weight on that runner's back. Nobody's putting a wall up or pushing him down the hill, right? Nobody's impeding the path. The runner can still run. But every step up the mountain is going to get harder and harder and harder and harder. That's the same with price. Price can go higher from here, but going higher from here is going to require more and more and more effort and work. And there will be less reward or less outcome for that work the higher we go. So I'm not telling you we can't go higher, just that it's going to be more and more and more difficult the higher we go. That's just the way that it works. So looking at what's up this morning, it might be easier just to look at what isn't up this morning. Start with that one. XXX China is down, nat gas, and the KWEB constituents, which is like China Internet ETFs or China Tech, basically, is down. Yeah. All right. I mean, that's okay. We look at what's up this morning. Yeah, basically everything else. Now, my benchmark is 0.5%. And if we look at 0.5%, it's pretty much with ARC, bonds, chips, finance, communications. I doubt that one. We're going to check it. Tech, quantum, Bitcoin, Mag 7, more Bitcoin, robots, more Bitcoin, miners, uranium, and more Mag 7. So we've got the sectors for a continued rally. We need these risk off sectors to remain flat. They don't really need to go down, right? We just don't want to see a lot of juice in there. So that'd be XLP, XLB, XLU. Although, XLU is changing the game, so might have to rethink that one. But we need the risk on sectors to continue to outperform. So finance, technology, communication, cloud services, chips, consumer discretionary. As long as we have those sectors, we've got an opportunity to continue the rally. But we still need to be mindful of bonds, treasuries, intraday, 0-day flows, headlines. The ARC stuff being up this morning um, makes me wonder if we're going to start to see more of that short covering rally and see a penny stock play. It tends to happen when everybody gets overly excited, right? We see even trash start to rise to the surface. And then, of course, those shorts are getting squeezed. They'll start to cover. It'll add to a little bit of a short squeeze, hedge fund factor rotation play. That tends to take a little bit of time. And I would expect it after the holidays rather than before, but whatever. Doesn't hurt to look. So we got ARC. Keep your eye on something like GME. I know it's pretty generic, all things considered, but there's an ETF called IPO. If we are going to start to see a small cap resurgence, that one generally starts to pick up. There's others. I got a watch list of tells I could put in the chat later. All right, I seen the VIX up. I kind of figured it was just a gap, but better to check than assume. So pot stocks are up. That's a joke. You don't want to rally on pot stocks. You don't want one based on solar either. So that's not good to see leading the markets. Uranium, yeah, I mean it's tied to Bitcoin. It's tied to the SMRs and AI and everything else. So okay, fine with that one. Bitcoin, tech, banks. Banks were making some funny moves last week. And they had some new banking regulations that were either going to be put into place or that were going to be taken off. I'm going to have to check some headlines on banks, see which way it went. Bonds are almost back to the year-to-date anchored VWAP. So we're talking TLT. If we can get above that, we can reciprocate what we had from below. So let's call it 88 to 82, it's 6 points. We could get 6 points on the other side. So from 88 to 94, 94 would be back up here at these previous levels. That's not bad. Lines us up with our previous commitment. That would be a swing trade though, right? Take some time. And that's if we can get above that year-to-date anchored VWAP, because we reciprocated what we had on top onto the bottom. Now we get a chance to return the favor the other way around. That's why we call it reciprocation. Chips are getting into this danger zone, SMH. Not to say that we can't exceed the previous highs into some new highs, but then what? So watch for a 111 or a 1236 reversal out of these highs. Could get into 290 on SMH, but I wouldn't expect any more than that unless it pauses, consolidates, digests the move that it already made. That would be a bit of a swing too, right? Still got work. Gold and silver are kind of dragging its feet this morning. Keep your eye on that. If it jumps in to begin participating, watch Bitcoin. All of this will be a collection of things that we want to keep our eye on to see what we're going to do with the S&P and the NASDAQ. Because right now, price ain't really helping us out that much, right? We're just stalled out here, getting nowhere. So we need a little bit of a tell. From the breakout of yesterday's price, we've already taken everything it owes us. At this point, we would have to break our own Globex high to get anything more. And you would want to run the measurement on just yesterday's high and play it with what you have from within our own Globex. So it's simple enough. We got to get out of the box. If we get out of the box, we've got a chance to run. And this is the box at the moment. Right? That's our Globex low to the Globex high. Deal with this, and we can run from there. To the downside, get through the half, which is basically today's floor pivot. To the upside, get through our own Globex and keep going. The measurement for the breakout would be all of this in the box with the 111, the 1236. Run from there. Really simple day. GTFO, keep your eye on the news, right? So that's what I got, guys. Be careful, be safe. I'll see y'all tomorrow.